Good morning, traders. This is your Forex market commentary brought to you by ECN. Today's commentary aimed to highlight the single currency. The single currency once again failed to break out from the short to medium-term top set at 1.3900 as investor sentiment shifted. This week is packed full of market-moving risk events, especially the release of the Eurozone CPI number that will confirm whether the ECB will follow through on its QE threat to combat deflationary concerns. Over in the United States, Fed Chairman Janet Yellen is expected to speak, and the market are anticipating clarity on the mixture of different rhetoricals from the different Fed officials. I hope that this commentary will prove to be insightful for you in formulating a successful trading strategy. First, in line with this discussion, we're going to break down the euro-dollar pair on the technical front. The euro-dollar market began this week's trading session in the lower 1.3800 band, after an aggressive market sell-off at the end of last week's trading sessions, on investors' profit-taking as the pair once again tested the 1.3900. This week is full of market-moving releases that will eventually act as a catalyst in determining the trend of this currency pair, as it can also validate whether the 1.3900 mark would be the top that the euro once again failed to break out from. One of the most highly anticipated risk events for this week was surrounding the release of the Eurozone CPI number month on month. As of recently, ECB President Mario Draghi made a connection between the elevated euro exchange rate and CPI number. The bank's president reiterated to the market that the strong euro has an adverse effect on the CPI growth. Therefore, the euro-dollar market approached the 1.3900 and 1.400 zone. The market anticipated a correction in this pair where greenback rebouncing and retracing all the losses incurred post-FOMC dovish rhetorical, or the ECB will need to step in and intervene to bring the single currency back to the level where its detrimental effect on CPI reading is diminished. Analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bearish market sentiment and recommend short positions on the euro. The hourly chart showed that the single currency opened today's Sydney trading session 2 pips below the Fibonacci resistance at 1.3850, while the short-term Fibonacci support is set at 1.3840. Ever since last week FOMC minutes release encompassing a dovish Fed rhetoricals, the euro dramatic rise from the intraweek bottom at 1.3700 zone to a short-term top at 1.3900, and in the process the trend price action broke below the 200-day simple moving average. Despite a correction in the euro-dollar market, the pair continued to remain above the 200-day simple moving average. This trend held great significance as 200-day simple moving average contained more or less of 1 year's worth of trading data and it forecasts long-term market sentiment, and currently the pairs are trading above the 200-day simple moving average, which is indicative of long-term bullish market sentiment outlook on the cross moving forward. However, this long-term market outlook on the single currency is not validated on the short-term moving average front, as the euro-dollar pair opened today's Sydney trading session below the 5, 10, 20 and 30-day simple moving average. Collectively, this is indicative of a sell recommendation on the technical front. So now it's time to highlight this week's market volatility opportunity. First in line, on Monday, we have the Eurozone industrial production month-on-month, forecast at 0.2%. Also, we have the US core retail sale month-on-month forecast at 0.5%, while retail sale month-on-month is forecast at 0.8%. In order for the dollar to rebound back and reverse this rally in US Treasury, retail sale number need to surprise the market to the upside with more than a 1.5% in terms of growth reading. On Tuesday, we have the German ZEW current condition forecast at 51.8, while we have the US core CPI number month-on-month at 0.1%. Also, we have the core CPI number year-on-year forecast at 1.6% as well. Lastly, on Tuesday, we have the highly anticipated Fed Chairman Janet Yellen announcement. This highly volatile moment can give the market a clear direction on the Fed, dovish from a hawkish standpoint in terms of monetary policy and its viewpoint on interest rate expectation. On Wednesday, we have the Eurozone CPI month-on-month forecast at 1%, and we also have CPI year-on-year forecast at 0.5%. Over in the United States, we have the US building permits forecast at 1.020 million. Lastly, on Thursday, we have the Philadelphia Fed Manufacturing Index forecast at 10. Moving along, let's touch base on the fundamental front on the euro-dollar market. The fundamental outlook on the single currency had been downgraded to bearish as the threat of another QE program hang in the balance as inflation number continued to remain fragile. 2 weeks ago, when the ECB openly raised their concern regarding deflationary pressure in the Eurozone, and that the chances are the bank may step in to stimulate the economy with more easing policy. To the effect of that rhetorical, the single currency sell-off hitting 1 month low against the greenback. However, last week's Euro bull run clearly indicates that the market revised the fundamental outlook on the euro as more ECB policy makers reiterate to the market that the possibility of another QE program is very small. As the market struggle to price in whether the ECB will implement another QE program, this week's inflation number will provide some clarity to this matter. In the case that inflation remains sluggish or below the growth forecast of the ECB and leading European economic indicators are rolling over, the options continue to remain on the table for the ECB to aggressively cut interest rate further as well as bring deposit rate into negative territory. Last week's Euro bull run can also be attributed to a weakening in the greenback fundamentals. With weak report out from the US labor market as well as weak consumption data and the Fed casting a shadow of uncertainties over the dollar interest rate expectation by changing the rhetoricals. The Euro-US dollar market seemed to defy gravity during last week's risk aversion sell-off in the equity market. The conventional consensus that the single currency is highly correlated to risk aversion and therefore a correction in the equity market such as the S&P 500 will also translate into a correction in the euro-dollar market to the downside. However, that wasn't the case last week. One possible explanation to this could be that investors are beginning to build the euro up as a safe haven currency as a form to diversify from the greenback. I want to thank all our listeners for spending their time with us, and until then, have a successful trading session, everybody.